Hello, trader. Did you know that the same trading strategy can be both profitable and unprofitable at the same time? How can that be? It all comes down to money management. What is money management? It is a strategy for using the money in your trading account. The money management rule determines the size of risk you will apply to each trading operation. The second is how many trades you will open simultaneously on your trading account. The third is trading on correlated assets. So, as you understand, if your money management is poor, no matter how hard you try or what trading strategy you find, you will still be trading at a loss. Conversely, a simple trading system with good money management will yield stable and significant profits. As for the pumping station strategy, it also requires good money management. And now, I will explain to you what money management rules you should apply in order to achieve stable and significant profits. So, let's get started.
So, friends, when it comes to money management, it is very important, and we should not neglect this issue. You always need to keep your finger on the pulse. As they say, proper money management will make your strategy stable and profitable. Poor money management will turn a pumping station into a tool for destroying your deposit. Therefore, always adhere to proper and sound money management practices. And now I will explain what you need to do to ensure that your money management is correct. So, the first thing is the size of the trading lot. If your deposit size is a $1,000, US dollars, Australian dollars, New Zealand dollars, Canadian dollars, it is irrelevant whether your deposit is 1,000 units of currency. The size of the trading lot should be 0.01. For example, if you have a deposit of approximately 2,000, then your trading lot should be 0.02. If you have a deposit of 3,000, then 0.03 is appropriate. For example, if my deposit size is $10,000, then I need to set the trade size like this: 0.1 for 10,000. And accordingly, the larger the deposit, the more you increase it. This is regulated. Open the pumping utility settings in the upper right corner. For example, I currently have the MT5 platform. I will be demonstrating my online trading on it. And here the size of the trading lot is slightly adjusted. It says trading lot here. The utility for MT5 and MT4 looks the same on the inside. All the variables are the same, similar. So, you know that you have a deposit of, say, $1,000. You set 001 here. I know that I have approximately $10,000. I will set the deposit to 01 like this. Okay, all done. And here, by default, the deposit I set is displayed. Although I can use these two buttons, plus and minus, to roughly decrease the size of the deposit, meaning the size of the trades, or increase the size of the trades. In summary, that's it. So this is basically, essentially, and fundamentally about the fundamental system. As for the smart closing system, do it just like money management. In terms of the system of averaging, it is important to note that there are different rules here. You should always have a trading lot size of 0.01 for up to 10,000. From 10,000 to 20,000, the trading lot size here is 0.02. So if you have 20,000, you should set it to 0.02. For 1,000 to 2,000, it is 0.20. That is, you have 2,000 and 0.02. Here you should set 0.02. So here, if you have approximately $20,000, set this for averaging. Also, if you enable ladder averaging and set the addition size here, which is a method used in trading strategies, then set it to 0.01. This is considered as a soft increase of the deposit amount. If, on another hand, you disable ladder averaging and instead choose to enable multiplication factor through martingale strategy,
Here, set 1.3 or 1.5. You can definitely set 1.4, but if you set 2, it means that each subsequent trade will double in size, and this will lead to a very significant increase in the size of the trade lot, which will be extremely dangerous. Set 1 for the multiplier, and 0.3 if you are trading with martingale. But all of this is risky. The best option here is definitely to set it to 1. Absolutely set the averaging to false, without a doubt. In order to execute trades without the process of averaging, you should make sure to set the value to exactly 3000 in this section. This ensures that your trades are executed as intended without any averaging involved. The averaging size between trades, which typically means that you will almost never reach 300 points from a drawdown, and in practice, you will almost never have averaging. That is, you will only need to adjust the trade lot. The basic strategy is 0.01 of the deposit currency for every 1000 units of your deposit. The basic strategy is to use a trade lot size of 0.01 like this for every 1000 from your deposit. In my case, if I have 10,000, I will set it to 0.1. This refers to the size of the trade lot, which is also referred to as the risk size for one trade. I have explained to you how this works. The second point. This is the number of open trades simultaneously. This parameter depends not only on the size of your trade lot, but also on the size of your leverage. The higher the leverage, the more trades you can open simultaneously. In Europe, brokers typically limit the maximum allowed leverage to 1 to 30. In the United States of America, it is 1 to 50. In Asian countries, it is usually 1 to 500. That is, leverage in Asian countries is several times greater than in Europe or the United States of America. And for residents of Asian countries, citizens of Asian countries find it much easier to trade than Americans or Europeans. But it's not a big deal. At the same time, a small leverage makes your trading less risky because the broker limits the number of trades you can execute simultaneously in your account. It calculates your trading lot volume. So here I advise that if you have leverage of no more than 130, which is a common leverage ratio, meaning you are trading with a European broker that adheres to strict regulations, you can have no more than 7 trades open at the same time, as this is a prudent strategy to manage risk effectively. If your leverage is 1.50, then 7 trades. If it is 1,500, then any number of trades in principle.
This is for the basic strategy and for the smart closing strategy. But keep in mind that the size of your trading lot should be 0.01 for every 1000 units of deposit. As for correlated assets, if you haven't noticed, currency pairs that have the same currency in the first or second position have similar quotes. For example, the Australian dollar against the Canadian dollar. The quotes are similar to the Australian dollar against the US dollar. Take a look. This is the Australian dollar against the Canadian dollar. This is the Australian dollar against the US dollar. This is the Australian dollar against the Singapore dollar. This is the Australian dollar against the Swiss franc. They are somewhat similar. So, the situation is as follows. For example, you receive a buy signal on the currency pair Australian dollar against the Canadian dollar. And approximately at the same time, you have a buy signal on the Australian dollar against the US dollar. 2 buy signals. And it can happen. It does happen. Not very often, but it does happen. And right at this moment where I am showing you the example, it occurred. You are experiencing 2 losses on different currency pairs simultaneously. And it's unpleasant. Here is a loss, and here is a loss. There are also currency pairs that have a mirror reflection. Here the Australian dollar is in the first position, and here it is in the second position. And here, the quotes will be in a mirror reflection when we have a decline here. Here we see growth, but as you can see, the quotes were similar, and here we had a buy signal that resulted in a loss, and here a sell signal that also resulted in a loss. Thus, you already have 3 losses on 3 currency pairs simultaneously. Additionally, let's take the Australian dollar against the Swiss franc, where we had a buy signal that resulted in a profit. As you can see, trading in this way, if you apply several currency pairs simultaneously, provides some diversification. That is, on one asset you make a profitable trade, while on another you incur a loss. Profit plus loss results in approximately zero. In other words, this is diversification. If there are many similar assets, for example, the euro against the Australian dollar also signals a sell, and it closed with a loss, then your trading drawdown increases. The similarity of results is not always bad because, for instance, here, pay attention to the euro against the Australian dollar. We have a profitable trade, and only here we have a losing trade. We had 3 consecutive profits on the euro against the Australian dollar. Now, opening the Australian dollar against the Swiss franc, we had 1 profitable trade. The Australian dollar against the Singapore dollar had no trades at all. The pound against the Australian dollar had. In this period of profitability in correlated currency pairs, where the Australian dollar is present, for example, coincided. Therefore, you experience super growth on all these currency pairs, resulting in a significant gain in your deposit. The global growth of your deposit has been very good. So it is important for you not to miss your signals. However, you must understand that you will not be able to execute many signals simultaneously if your leverage is limited. Therefore, you need to trade. How should you do this? I would advise the following. For example, if you have 2 currency pairs, the Australian dollar against the Canadian dollar and the Australian dollar against the US dollar, along with several other currency pairs that include the Australian dollar, and you receive a buy signal, or a sell signal simultaneously across all of them, or if these are mirror currency pairs, where the Australian dollar is in the first position, and in the second position you have a mirrored quote that is roughly similar, it is better to execute a trade on the Australian dollar against the Canadian dollar and skip that signal. Then, the next day, open the platform, and if, for instance, the quotes have fallen and the signal has not closed by that time, then make a buy trade here. This way, you will make a profit here and incur a loss there, resulting in a diversified outcome. That is, it is not necessary to make trades on correlated currency pairs simultaneously. Let some time pass. Yes, here the price could possibly reverse like this and touch the red line. Your trade would have closed here. Then here, for example, the pullback might not be strong enough for the trade to close, and then the quotes would drop here. You would make a profit here because you made an additional trade. Thus, you should. Understanding that quotes move very similarly across many currency pairs can actually allow you to gain additional profit. You will see that one pair has gone into a drawdown, while you choose not to trade on the second pair. Instead, you wait until the drawdown reaches its maximum size, and then you make a trade. For example, this would be the case here, and you would make a profit. This is how you can trade on correlated currency pairs, while increasing your profitability rather than raising your trading drawdown. So I will repeat once more. The first rule is to control the size of the trading lot so that the lot size is 0.01. For every 1,000 units of deposit, if you have 10,000, then do as I had, 0.01. If you have 1,000, it should be 0.01. And if you have 1,000, it should be 0.0.1. If you are trading with averaging, then 0.01 should be used if your account balance is up to 10,000. If it exceeds that, then 0.02, and if it reaches 30,000, then 0.03. This is if you are trading with averaging. As for correlation, you should not enter trades simultaneously on all correlated assets where the same currency is present in different currency pairs. We received a signal here and we missed it here. If you can, check the next day. If there is a drawdown, make a signal at a different, more favorable level. With one pair, you are likely to incur a loss, but with another, you will gain profit. If you use smart closing, do the same. Your trades will not close at the red level on the same time frame, but the utility will implement a trailing stop on other time frames. Nevertheless, profitability will increase in this way if you skip signals on another correlated currency pair and execute them at more favorable levels for you. Thus, this money management, in which I outlined the rules, will help you, first, reduce trading drawdown, and second, increase profitability. And third, it will help you avoid situations where you could lose your deposit altogether. This is completely excluded. You must trade for profit and you must trade consistently for profit. That's all. See you in the next lesson. Goodbye.